the biggest scam in life is paying taxes on the money we make, paying taxes on the money we spend, and taxes on the things we own that we already pay taxes on with already taxed money.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have Davis and Chuck Oliver. Chuck is a nationally recognized radio host and best-selling author, recognized wealth strategist who works with baby boomers, retirees, and business owners nationwide who desire asset optimization and wealth preservation planning. Their focus centers around having a written, comprehensive plan incorporating tax savings, reducing unnecessary market risk, maximizing income and growth while securing peace of mind with asset and estate planning protection. Today, we're going to talk about how we use the next level income strategy, how to make more money, keep more money, which is what we're going to dive in with Chuck and Davis today to ultimately grow your money for you and future generations. Gentlemen, welcome to the show.
Thank you for having us.
Yeah, thanks, Chris.
Absolutely. Yeah, we're doing this just a few weeks after tax day. And, you know, I always like to ask people, like, are you happy with how much you're paying in taxes? And, you know, if people say, yeah, I think it's fair, I say, great. Like, how do you ever like write an extra check to the Treasury? And, right. You know, it's one of those things. It's like, if you think you should be sending more money to the government to manage your money, then, you know, you can always write that check to the U.S. Treasury. They will cash it. I can tell you that. And, you know, we talk a lot about investment opportunities. Our investors club gets investment opportunities, and everybody wants to jump to that. But the next level income strategy is very specific. We talk about how to make more money, how to keep more money, and how to grow your money. And you know, those investments fall into the grow bucket. A lot of people jump over to this key portion, and I've been very, very happy and was very excited to get connected through you all, through our mutual friend Ann. And you guys do a phenomenal job of that second portion, you know, the legal and tax strategies behind keeping more of your hard-earned dollars. And we don't often have two guests on the show, but for those of you that are listening, Chuck and Davis are a father-son duo, and we've got some similarities in terms. Davis actually went to the same high school that my son's going to. Fantastic community that we've talked about. But I don't want to steal your thunder, guys. Let's talk about what you do at the Hidden Wealth Solution and a little bit about your background and how you founded it, Chuck.
Sure. Well, thank you for the opportunity. It's always great to have an impact on, you know, helping people with their wealth, and this can be life changing, as you've experienced, as a number of our clients have experienced. So it's I forget what somebody said, right? You never want to work a day in your life, right? You just want to make a difference in somebody's life daily. So right. I think saving taxes, right, you know, goes such a long way, right? So Hidden Wealth was actually created because of the void of personally and professionally going through being very blessed, very fortunate to have a business. I'd been self-employed since I was 19. I didn't know an S corp from a C corp, right? So I knew how to definitely overpay taxes. I knew very little. I just knew I was going to be an entrepreneur. Both sides of my wife's family, both sides of my family, all entrepreneurs, and so, you know, finding that. And it was fascinating because it actually goes back to your roots in Asheville, that the biggest scenario that prevents people, we find, from really becoming wealthy is not paying attention to the things that they actually have the greatest amount of control over, and not just daily discipline, right, but the ability to control their taxes. And taxes became so out of control that's how I kind of coined the concept, the process of hidden wealth, helping people to discover and uncover their hidden wealth. And for us, it starts with taxes, because if we don't get the taxes right, you know, everything else is going to be inferior, because just as you said, it's very apropos as far as where we are in this time of the year. Most of us to this moment will work through the timing of this coming out and pretty much not net a dollar for ourselves, right? We spend pretty much the first 4 months of the year paying the IRS, right? It's only till after we kind of get into May and after that people actually end up netting something for themselves. Well, that's
Yeah.
silly. And so that's why we took the approach that the thing that was really holding people back, whether it's a high income earner, a successful business owner, somebody that's been a heavy saver in tax deferred accounts like traditional 401ks, IRAs,
Yeah.
they don't realize the magnitude of, we all recognize the magnitude of compounding interest, right? We don't really recognize the impact of compounded taxes.
Yeah.
And so we ran a couple things, Chris, in anticipation of this. We determined that predominantly, especially for accredited investors, let's say a couple married jointly, let's say have 300,000 or more of taxable income, they'll spend almost $4 million in taxes over a say an average lifetime, just in
Wow.
tax, right? 4 million
Wow.
bucks. And when you think about that, that's a really big number. So we're big on it's not what you make, it's what you
Yeah.
keep.
Yes,
And if
sir.
people could redirect taxes into things like that, you and Matt and obviously have great access to opportunities and different types of fund structuring and things that people will never get access to, which is very unique into itself. Then that's really where the wealth building comes. Is hey, let's get the federal government to subsidize some of our wealth building, not having to work more,
Yeah.
pay more tax and then try to grind out what we can do to get into these opportunities. A lot of opportunities are missed because of the tax drag that could be taken care of.
Absolutely. And you said pay through, May essentially with the
Right.
IRS. And then you got state, you got local taxes, you got your property taxes, you got, sales tax. Most people they're working into July. I think the tax freedom day is sometime in like June or July now if you add it all up. And Davis, you're going to go through some case studies here. And I love how you phrase that, Chuck. A lot of people, first off, if you save $1 in tax, it drops directly to your bottom line. So our goal is if, hey, we can help you save $1 in tax, that's another dollar that you can put into investments. That's another dollar that you can keep working. And I forget if my accountant told me this or I read it somewhere, but it's like Monopoly, right? If you understand the rules, you can play better. The IRS is like a rule book. And if you play by their rules, they want you to invest. They want you to create and grow businesses, which is why there's a lot of these opportunities out there.
Well, yeah, and as Davis talks about these case studies, and that's what's
Yeah.
great in having a tax wealth team, right? Where we're
Yeah.
focused on the tax, and there's so many little caveats of not just different strategies, but the way you can actually layer different strategies and
Yeah.
really get out in front of it. One of the favorite quotes, he's actually been titled the father of tax planning. His name's actually legal name is Billings Learned Hand. He was a former appeals court judge. They kind of called him the 10th justice. He never made it to the Supreme Court. But what was fascinating is he got labeled as the father of tax planning. And I love his quote, and I'll go through all of his quotes, but his main
Yeah.
quote is, there's two tax systems in this country, one for the informed and one for the uninformed, but they're the same tax system. It's
Yeah.
just to your point, right? If you take the time or work with people that are focused in an area where that's their unique ability and they can find the areas, which again, I'm the first to tell you how to be an overpaying taxpayer, which is why I was very motivated to find out ways to, legally, ethically, and morally leverage the tax system to my advantage as opposed to their advantage. And I'll leave you with this as we go to these case studies or other questions
Yeah.
you have, in this case, Chris. But one of the favorite things that a client sent me was this: the biggest scam in life is paying taxes on the money we make, paying taxes on the money we spend, and taxes on the things we own that we already pay taxes on with already taxed money.
Yeah.
I mean, just let that settle for a
Yeah.
moment. I mean, taxes are a complete rip off. And so take advantage of taxes. Don't let taxes take advantage of you, we like to say.
Oh yeah, absolutely. And then I think you left out the part where, and you and I have, in your team have talked about this with my stepfather. And then if you don't properly plan, then you pay taxes again on the money you have left over when you die. And
Right.
it's really, it can really erode that. And again, if you're listening and you say, hey, I think the federal government and the state and local governments do a phenomenal job with my money better than I could, then send them your excess money.
Send them more.
There's yeah. But if you feel like you can grow your money, if you have other things that you can invest in and grow that money and be productive with, or donate, that's one of our big things is to give people that. Davis, your dad Chuck here shared a little bit. Talk a little bit about your background, why you chose to go work with your dad, if you don't mind. I first off, I got to say, I so admire this because I have two boys, as a lot of the listeners know. So it's awesome to see that you guys have a family business in this.
Oh, well, thanks, Chris. Yeah, most clients just assume I've been drinking the Kool-Aid forever. But no, I have a background, I got an economics major from UNC Chapel Hill, go Heels.
Yeah,
And,
great school.
there,
Great school. Going to
yeah,
watch him play Duke in lacrosse Friday night at 8 o'clock. So I'm
there
excited.
you go. There you go.
Yeah,
Yeah, hopefully the Heels win, but no offense to Duke. But
I do too.
saying all that, right, I got started as an analyst in the oil and gas space, right? So I really seeing the private markets, right? It's kind of like, my dad just quoted there, right? There's really two kind of tax systems. One's the understood, one's just not the understood, right? And,
Yeah,
realizing that, right, as I started seeing, we're not going to talk about oil and gas today, but that's a deduction, a tax
yeah,
saving asset class that goes back, all the way to 1913 in tax code, right?
yeah,
Where these IDCs, intangible and tangible drilling costs, you can write off against active income, right? So
yeah,
from that, right, what we've done over the years is, paying taxes ourselves. It's really how do we find ways to get rid of this active income, right? And you mentioned a few, Chris and my dad here today. Where is that coming from? If you're a business owner, right, it's that 1099 income that you're paying quarterly taxes on, and you don't really know what you're going to make, and you want to avoid penalties and interest that might hit you
yeah.
there, right? So you want to make sure you get them in, right? But there's
Yeah, and I
ways
think,
to have
well,
business strategies to avoid that.
and yeah, and I'm sorry to interrupt, Davis, but a lot of
No,
people,
please.
especially W-2 owners,
Mhm.
business owners tend to be a little more savvy, because they have control over, do their expenses go through their business, like a car, for instance, right?
Yeah.
So I just drove last weekend to Wilmington, North Carolina. We have a property in Leland. Do a property visit. That's a business deduction, right? I have
Absolutely.
opportunities to write that off. If you're a W-2 owner, a lot of people say, well, I just don't have these options.
Yeah.
I shoot, my taxes are taken out before I even get my paycheck. So,
Mhm.
what I'm excited, Davis, is you're going to share some strategies where whether you're a business owner or a W-2 owner, there are options out there. If you're proactive, if you work with an accountant, and by the way, you guys can work with somebody who brings their own accountant along.
Sure.
But if you work with your accountant and you just send them the proverbial shoebox of receipts at the end of the year and they file your taxes, you're probably not going to get anything in that scenario. So we're going to talk about how to be proactive.
Yeah.
Yeah, no, I'm glad you brought that up, Chris, because I was going to right next is, the W-2, working in corporate, wherever your industry you're in, and as a W-2 employee, you kind of think you're helpless, right? It's kind of like you just said, it just comes out of the paychecks, right?
Yeah.
I'll go ahead and if it works for you guys, I'll dive into these case studies because I think, and
Yeah, let's
hopefully
do
your
it.
audience will be excited to see that here, and the first one we'll even cover is a W-2 income earner, right? So I'll pull this up here. So we have some visuals.
Yeah, and if you want, well, if you're watching on YouTube, Davis is going to share some information here on the screen. If you're listening on the podcast, we'll make sure that we have a link here so you can check this out if you're just listening here today. But we're going to go through it so you can listen along in the car for those of you that are out there listening, and we're also going to have it up here live.
Yeah, so I'll try to give some good auditory here. So people that are just not visually seeing. But are you able to see my screen, Chris and Dad?
Looks
Yeah.
great.
Perfect. Okay. So this is a great case study. We'll talk about just two strategies. There's a lot out there. Again, we're looking for strategies, like I said, that help reduce our active income, right? And then for Chris's point, right, we want to take that active income and do some like things that Chris has of investments and his team, right? And ideally take what we've saved in tax, and we'll show you what these tax savings are and what we do, and put them over in passive investments that generate more deductions, more tax savings, and more cash flow to really ideally eliminate that active income and have things working for us more passively, right? So that's kind of
Wow.
the end goal. But how do we get there, right? So
Yeah.
here You'll see on the screen, right? Just we got a tax return and kind of a little bit of slide deck to kind of walk us through this client situation, right? So this client happens to have some solid income, W-2 earner. In fact, this client's out of the state of Colorado, right? And so I'll walk kind of through this tax return. He's making about 303,000 is a W-2 salary here, right? Active income. He's got some interest income, some dividend income. What he really had a lot of, we mentioned other active income and kind of doing the long-term planning, which is a big thing we help clients with, Chris, is he did about $1 million, $989,000 of Roth conversion. And that's simply moving
Mm,
money from a
okay.
tax-deferred environment, a tax-free environment, which is a Roth account, to grow and compound tax-free from, when you reach over 59 and a half to take out of that 100% tax-free and what it's grown to, right? So this client, he's 62 and he's getting closer to retirement in the next 3 to 4 years. So he wants to start doing some of that proactive long-term planning. So that was some of what we took into account for his situation.
So
But that
real
conversion,
quick, Davis,
go
my
ahead.
apologies here, but just to underscore that for our listeners.
Yeah.
So if this would be if you've been putting money into a 401k through W2 income and doing that, a lot of
Mhm.
people have phased out of. I remember when I had my Roth and my boys have Roth IRAs. A Roth IRA is great because you pay tax on it and then it grows and then you don't pay tax when you take it out. So this is taking a 401k or an IRA that would be taxed when you take the money out and converting it.
Yep. Yep. So and then here we're going to show you using a tax deduction strategy, right? To show that income we've taken out that's now we're taxed on reports less. We're paying less in tax. So I'll walk you through that here. So his client, being in the state of Colorado, has federal and state tax, right? So unless you're in Nevada,
Yep.
Florida, Texas, New Hampshire, Wyoming, right, you're paying some state tax most likely for those that are listening. So this client, all combined, the 303 of W-2 income, the $989,000 of Roth conversion. He also had a capital gain here. You'll see factored in about 161,000. All combined, we had about an annual income of $1,457,506. And he owes a tax bill, federal and state, of $517,000, $333. And this is before any strategy has been implemented, right? He's at a 35.5% effective tax rate. So the fun stuff, how do we help them, right? So this is kind of the first introduction to Chris, an actual tax deduction, existing tax code. It's called Section 1A, right? Internal Revenue Code 181, right? And it
Okay.
happens to be behind film investment, movies, right? So for the audience out there that likes, all the streaming and TV shows out there, this might be up your alley, right? And we'll, can happily share some of the films clients and ourselves have invested in. Some of these you probably have heard of, or at least heard of the actors and actresses. So with this, right, how does it work, right? Where's 181 come from? It comes from most, films back in the 90s, early 2000s were produced in Canada, Mexico, other countries outside the United States. So United States saw kind of the incentives and all the stimulus that were going behind those films that were being produced outside the United States. Said, hey, let's bring those back here and get more jobs and things of that nature, right? So in 2006, they passed this Internal Revenue Code, and it's been there since, right? That you can invest in films, and by investing in the financing of film, it generates a deduction, right? So what the deduction happens to be, and what this client did, is you see on the screen, he invested $225,000, right? And this is important, Chris, right?
Okay.
Either we're writing a check to Uncle Sam for
$517. Yep.
$517,000, or in this client scenario, we're outlaying $225,000. He received a $959,000 deduction. Now, there's some things, and what's great about working with our team, Chris, is as you have worked with our tax team, Candace with New Way Accounting, she
Yep.
knows exactly how to take these deductions. And in this client scenario, using our tax team and Candace's prowess, he was able to use with loss limitations about $769,000 this year of 2024 of that 959,000. He'll get to use the whole deduction. Get me wrong there.
Yep.
He'll use the rest of that for 25 planning, but that's what he got to take. And so as you see down here on line 8, right, that loss of $769,000. Again, we say this a lot, but I think it's important for your audience to hear. It's not about what you make as much as what you take home,
Right. Right.
right? And
And
here,
our listeners
yeah,
understand that through real estate. So if you're listening, you're like, wait, how does that work? these are paper losses, right? So real estate, you have depreciation. You can make money, but you can on paper, according to the tax code, you end up losing money. And a lot of people became very familiar with this when Donald Trump stood on stage and Hillary Clinton
Yeah.
was chastising him, and he said, "Hey, I'm I, I'm just doing what I'm taking advantage of the rules that are out there." And I think, what did he say? Just like all your friends and donors that are
Exactly. He
out there
closed
too.
it.
Look,
I'm just
I stood up and cheered, right? Because she chastised
yeah,
him for, she
yeah,
said, what? You reported like making $750. And he said, yeah,
yeah,
that's right. Right. I
yeah.
used
Because I'm
everything
smart.
to the full law.
As
Yeah.
Dave
Because I'm
Chappelle
smart.
made.
That's exactly what
Yeah,
he said. Yeah. Because I'm
yeah.
smart.
That's a good clip. So yeah, here, like we were showing you, it's about being smart, right? So this client, they're after that deduction, their tax bill and their taxable income, again, a deduction takes what you make, right? And it minuses by that deduction amount, right? So a lot of you experienced the standard deduction if you're married. This year it's about 30 grand, right? So if you make 100, you minus that 30,000, now you're paying tax on 70,000,
Yeah.
right? And so now that's understood, right? What this client did after that $769,000 deduction, he now has a taxable income of 642,000. He took his effective tax rate and went from 35.5% to 12.5%, reduction
Incredible.
of 23% on his tax rate, making his new tax burden $182,000, right? So what was his ROI, right? Because again, remember we talked about an outlay here, Chris, and I think it's important, right? I'd love to
Yeah,
tell
good.
you,
Yeah, I like this slide here.
it's a good one, right? Because everyone wants to know what the ROI is, right? And this is what I love about tax planning and tax savings is, you go to the stock market, right? People would lose their license if I told you, hey, Chris, I can guarantee you in Apple stock, I can make you 149% the next year. You
Can't
look
say
at them
that.
funny
Yeah.
because you'd be like, no way you can promise me that. With tax savings, tax codes written as plain black and white. It's just how you understand it, right? And so this client is going to be receiving $335,000 of tax savings. He remember outlaid still 225. He got that back, right? Made 335 plus another 110,000 of tax savings he gets to keep that he never had before. 110,000 he can reinvest in other opportunities to grow his wealth, right? And so that's why we like to start with the tax, right? And this is just
Love it.
one
Yeah.
one case scenario of getting there, right? So hopefully the tax returns understood and the deductions understood, but this is the main concept here is you're able to put as little minimum for this opportunity is 50,000 to generate a $215,000 deduction, right? So again, you don't have to be someone with $225,000 of capital, right? Everyone, has their cup of tea, and that's really where the planning comes in that we help most clients with. Number one, understanding what this tax code is all about. Number two is what makes sense for their own situation, right? Because
Yes.
it's not one size fits all.
Absolutely.
Yeah.
Yeah.
Yeah. So
So
quick question here
go
is
ahead, Chris. Yeah.
I know because you got another example. So, is what's kind of the point where this makes sense? Because I remember very
Mm.
vividly sitting with my accountant about 10 years ago, and he said he grabs a bottle of bourbon and he pours me a drink. This is like late in the day. It's like 5 o'clock. Um, and he sets it in front of me, and I'm like, what's going on? And he goes, Chris, what number were you prepared to hear when you came in here today? And I knew that the number was going to be substantially higher.
Yeah.
I got hammered. I had a significant six-figure tax bill that year, and it's when I said, "Wait a minute! Like I've got to start looking into things." And that's when my journey began down this path about 10 years ago. So yeah. So at what point, I mean, if you're making 100 grand, 200 grand, 500 grand, like who are most of your clients that you're working with to help with these strategies?
You want that one, Dad? I'm happy to answer that.
Yeah, I'll take it.
Yeah.
We get that question quite a bit, and we always try to reiterate, right? Who's this for? Who benefits the
Yeah.
most? Uniquely enough, there's really tax saving strategy for, a lot. I mean, predominantly for almost everybody. But as it relates to kind of the significance of tax savings, I'd say again, high income earners. So if you're single, maybe 200,000 or more, married, filing jointly, maybe 300,000 or more. I'd say that's kind of probably the base camp area. But at the same time, somebody may have an unusual liquidity event, selling a business, selling a
Yeah.
property. Maybe they have some restricted stock units or stock options they're exercising. So you kind of take it on a case by case. But I will say this, Chris, that what I love is we actually work with a lot of retired CPAs as clients. It's kind of fascinating because there's, as you put out, right, there's
Yeah.
a significant difference between tax preparation and tax planning, right? One's just to your point, pouring you bourbon and reporting the damage, and then gives you the invoice. Then there's others that would sit you down and say, hey, look, in preparation before something like that triggers itself, let's identify where you are, right? One of my favorite quotes is all progress begins with the truth. So here's
Mhm.
the truth of where you are. We
Yeah.
like to say, here's the tax road you're on. And then here's the tax road you could be on. And that's the significant difference kind of between an archaeologist, as I joke and call
Mm.
tax preparers, right? They're
Yeah.
just recording history versus a architect, which is obviously helping you build, your tax savings. So I'd say
Right.
high income earners, but you hit it on the head. We've got 124 trillion great wealth transfer. I'll make this because I don't want to miss this other case study that is going to change hands from generation to generation over the next 20 years.
Incredible.
And
Yeah.
people should be looking at doing advanced tax planning. Let's say somebody listening say, you know what, my dad or my mom have,
Yeah.
high required minimum distributions. The government's forcing them to take money out. We had a client just this week that saved a significant amount of money and said, Chuck, I was listening to your podcast or I was listening to your radio program. I didn't even know what a required minimum distribution was. So
Yeah.
some of it's looking out for your own taxes.
Yep.
Some of it may be because you're building your business, you're building your
Hmm.
income, and yet you know you're going to get faced with a pretty big tax burden because of parents, and
Yep.
you can do tax planning for another generation. So we think it's a
Yes.
multi-generational approach. So I think high income,
100%.
heavy savers, and tax deferred would be a
Yeah.
starting point.
That's a great point. And I think if you're listening, I want you to hear this. A lot of people, I have a lot of investors, they're in their 60s, early 70s. They say, Chris, I'm getting hammered because I'm forced to take the required minimum distributions, the RMDs, out of my qualified retirement plan. And then I have to pay tax on that. And they said, I don't need the money because I have money coming in from my passive investments. Maybe they still own a business,
Mm.
or maybe they're consulting or doing something like that. So, and that's an excellent point. You can help work around that. Davis, I want to make sure we share this next example as well because it's very valuable. But I'll let you kind of wrap
Yeah.
up any thoughts on here.
No, yeah, and for the sake of time, love talking tax, especially if we can save in tax. So this next example I'd say
Yeah.
is even more exciting, right? So a little bit different scenario we have here. So this client has less in kind of the Roth conversion game than the last one being about 1 million. This one has some really high W-2 income. So let me pull this up here, right? And so with the client, right, we used a really unique strategy that we'll get into here. But to kind of break down his client profile first, right? So in fact, he just retired. This is last year, right? Is a really tenured airline pilot, right? So he was making about 800 grand a year, as you see here on the 1040. That he had in reportable income. And it was actually his like kind of highest earning income year, right? He's
Yeah.
worked hard. They start really giving a lot bigger payouts the closer he gets to retirement for these airlines. And so again, if this could be anyone, whether you're a business owner or W-2, the scenario really holds true. And so again, being a W-2, he didn't have a lot of ways to generate deductions, right? Because you didn't have, without businesses, that's kind of the creme de la creme of how we can generate deductions, like you said, writing off
Yeah.
mileage, things like that. So we did a unique strategy where we actually helped the client create a business, right? Something he didn't have before. But again, he's
Oh
busy
wow.
being a pilot. He's in the air. So he didn't really have as
Right.
much time to go out and manage a business, right? So how do we do that, right? So this strategy is really unique in that, and it's a unique one for sure. And it's what we call our 10 times tax deduction. So for this client scenario, income added up, you'll see here, if you add all this up, we get about $925,000 of income in the state of Virginia. So again, another state income tax state. And on that, about a 33.4% effective tax rate, paying about $309,000, right? Pretty hard to,
That's a good income right there. Just
right?
paying it
Yeah,
in
you're
tax.
happy with that. You're
300K in
having
tax.
tax. It's crazy. Yeah.
Yeah.
And so what do we do for this client, right? Because you'll see here, there's a $620,000 loss. Well, how do we get that, right? So I'll give you a little background on the tax strategy we used here. And this is called Section 179. For you
Yep.
business owners, you've probably heard of this before. I know, Chris, I'm sure you've before,
Yep.
right? And what
We've
Section 1,
used that. We've used that frequently.
good, yeah, you're familiar, right? So this is a unique way to play it and use it. And we use this ourselves. And so here, you have an active business for this year of 2025, right? And you have a business equipment expense of up to 1.25 million, you can write all of that off against active income, right? So what do we help this client do, right? With this program, right, I like to kind of, explain clients like this, right? Since a lot of your clients have familiarities with real estate, I'll use that as kind of a starting example,
Yep.
right? Imagine Airbnb, right? I'm sure everyone on this
Yep.
call, or majority of us know what Airbnb is. We've used it. We
We've
even
got
maybe
we've
have
got we've
short-term
got two
rentals.
Airbnb units ourselves. So
Exactly. So take the same concept, right? And so as you know, Airbnb doesn't actually own any of the real estate. You own your
right.
short-term rentals on the platform,
Yep.
right? You just use the platform
Yep.
itself. Take that same concept, now it's applied to the $80 billion a year of short-term equipment leasing industry here in the United States, right?
80
Different
billion a
asset.
year.
80
Yeah,
billion. Yeah.
80 billion.
Wow.
It's a big.
Yeah.
So companies like United, Sunbelt, Equipment Share,
Yep.
those are, here we're getting to tap into the sixth largest equipment share. They're about $7.5 billion large equipment domestically here in the United States, about 240 locations, one of the fastest growing, and partially because of this program itself. So what this client did, right, he wanted to kind of do some planning for this year of 24, and now here we are in 25, right? And so what he did was, in this program, we can put as little as $80,000 down, right? And this is what he did. He bought $800,000 of equipment. Well, how do you do that with $80,000 down? Just like most of your clients, if they acquire real estate, and I'm sure you've done, Chris, you don't put 100% down most of the time, right? Maybe 10, 20. Here you can put as little as 10% down, right? And borrow through commercial lenders we help clients get approved with in this program, borrow the 90% loan to value, right? So in this program, we can do as little as $30,000 down to borrow 270 to get $300,000 of equipment. This client obviously did a larger amount because he had a larger amount of income he offset. So here he borrowed 720, took down, put down 80,000 of his own capital. That was his outlay, right? Well, the big thing a lot of clients ask, Chris, is I'm sure you being in real estate would ask, okay, we just borrowed $720,000. Am I responsible to pay that $720,000, right? That's kind of like the elephant in the room here.
Sounds great, but
Exactly, right. And so this is the nice piece to why we all do it, and a lot of our clients love this program. And this is a key point, and I'll reiterate: you are at risk, your business, and you are at risk for the loan, but you are not out of pocket to pay back the principal and interest payments that are due every month with the lender you get approved by.
Yeah, repeat that, Davis, because I don't think everyone's going to grab that.
Right. Every month, right? You put the 10% down, that $720,000 you borrowed in this case scenario for this client, he's going to receive from his equipment business, like clockwork, the principal and interest payments due. So for this client last year, the principal and interest payment was about 8%, right? So that's going to come into his business account from his equipment business, and it's going to go right back out to pay the lender, like clockwork.
sure. Yep.
Right? So, yeah. So again, you are at risk for the loan and have to be no risk, no tax savings. That's a key part of the tax savings. You have to have some risks materially.
Yeah.
But he's not out of pocket, right? Now, quite frankly, I wouldn't do this if, I had to, pay the principal interest myself. It's just not as appealing, right? So that's the big attraction. Now, kind of keep a high level here. There's also some other great benefits with this program. That 80,000 is going to cash flow for him as well, taxable income to the business, right? And that's a really actually a good thing, right? One thing to save tax. We also want to make money on our money, right?
Absolutely. Yep.
And so this client here, they got to use of that $800,000 deduction, right? That they put $80,000 down for, $620,000 with loss limitation rules, right? Because this is his first business, right? And unfortunately, without him having a high reportable business income, he doesn't get to use that full, if he had $800,000 of business income, he got to use the whole deduction. Fortunately for him, there's some loss limitations, again, that we can educate clients on if we are able to serve you. So here, that's why you're seeing this $620,000 loss, right? So what it did for this client, right? What is the impact, right? We went from a 33.4% tax rate down to a 7.4% tax rate. Huge. He went from paying $309,000 in taxes to $68,000, saving him $241,000 in taxes. He made 302% return on his investment just in tax savings alone. Wow. Forget anything else. So that's the excitement, right? What do you do with $241,000 you just saved in tax? The options are obviously endless. There's a lot of exciting things you can go from there.
Yeah. Love it.
Yeah. What a lot of our clients will do, Chris, is they'll just recirculate. It's kind of like brush, rinse, repeat, right? Kind of like, getting accustomed to that formula. And they'll, one of our favorite, one of our clients' wife's a CPA, and he contacts us usually about this time of the year, and he's like, if he's not on extension, he'll say, "Hey, what did my net come out to? Because I want to use that tax savings to do this year's tax savings, right?" So you could
Yeah.
just kind of recirculate the process.
Absolutely. And yeah, and what I love is when we first got connected, we're big fans of cash value life insurance. And I know you guys, that's a whole other thing. We need to do another um, podcast talking about, the legal and the proper structures to set up with respect to that. But this is how the wealthy do it. They have their business and their income that comes in. They use the right legal tax and insurance structures to maximize their after-tax income, and then they reinvest it and create this giant flywheel effect that ultimately continues into the next generation, which you guys kind of alluded to a little bit earlier.
Yeah, the thing that costs us the most, ironically, it's fascinating, ends up being the thing that gets the least amount of attention,
Yeah.
and it's tax. And it's unfortunate because I think some people just give up because it's like, well, hey, my CPA, surely he or she would know. They don't know. And I always kind of give this
Yeah.
as kind of a point of emphasis. A lot of people we work with make way more than their accountant or their CPA. So the
Yeah.
CPA or the accountant doesn't have the same, motivation to save taxes because maybe some of you listening, maybe your tax professional doesn't pay a lot of tax. But don't think for a moment they're going to bring you a strategy unless they're versed and trained. There's not one course of curriculum in the CPA on tax planning. It's all on tax accounting. So you got to be careful of that. Just as you said, you got to kind of know whose audience you are.
Yeah.
Know whose audience you are, because if you're paying a lot of tax, you can save a lot of tax.
Absolutely. Well, I can't believe we're already to the end of our time here. But if you're listening and you say, wait a minute, like, yeah, this is me. I want to learn more. We're going to have a special link here in the show notes for you guys. Also, at the email and in the show notes of this podcast, you can check out the webinar that goes along with this. And what I love about you guys is that a client can call in and you guys can do a free strategy session. You can look and explain to them what would work, and there's no cost to that on the front end. Is that right?
Yeah, it was a very simple 4-step process. We'll go through it in the webinar, but it's just a tax discovery conversation.
Yeah.
Easy go to if somebody wants to request what we call a saving tax optimization plan. The acronym
Yeah.
STOP in a book I'm finishing, but it's just go to taxessaved.com. That's taxessaved.com, and there's a place to click analysis request, and it's a complimentary analysis. And we actually show the client where the tax risk road is they're traveling, and then where the reroutes are to save.
I love that. Chuck Davis, this is one of my favorite topics, and love to help people make more money, keep more money as you guys do, and ultimately help them grow their money. If you have some interest, click on the link here in the show notes. Also, check out our webinar. If you missed it live, we'll have a recording here for you that you can request as well. And gentlemen, we'll surely have you back on to share more hidden wealth solutions.
Thanks a lot, Chris.
Thanks, Chris.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.